Howdy, Jacob here. Today we're looking at Clarus Corporation in the leisure products industry. 234 million market cap on 186 million enterprise value. They design, develop, manufacture, and distribute outdoor equipment and lifestyle products. Outdoor segment offers apparel such as shells, insulation, mid layers. Okay. So these look like non-mandatory products that when times are good, people are probably buying a lot of. And we did see the 2 years post-COVID, 19% revenue growth. This is going to be a pretty cyclical business if it's anything like the other leisure products industry companies that I review. Gross margin, okay, 34% operating margin, having trouble finding profitability, it looks like. So that's a little surprising. With balance sheet of 11 million cash on hand, 120 million short-term debt. I'm not sure how that enterprise value is there, but let's look at the insider ownership quick. About 9%, not bad. Cash flow statement shows huge acquisition, but again, free cash flow is also all over the place. So even if they average $15 million, they have $120 million due in the next year, because that's what it means to be short-term debt. So I'm a little bit concerned about that, but it looks like they made a payment over here. They sold off. Sold off an acquisition or net acquisition to fund this debt. So that could change their. That's just a lot of change without a whole lot of data, which is pretty tough. So, I'm just going to get right to it. I'm not going to waste my time here. So, on the revenue growth side, I could easily see them grow 5% a year. I don't think they deserve any sort of premium or anything. Margins, they're not very great. So let's do a little bit of a range of 4 and 5%. Share change. It looks like they do have a dividend. Interesting. Dividend pays out 1.6%. It's about $4 million. Yeah, that's pretty reasonable, actually. So we'll keep that the same because they haven't really changed that in the past. And then, have they repurchased shares? No. They issue $5 million in stock-based compensation. That's about a 2% increase of shares per year. So we're saying that, again, I don't really know what the company's going to do with their capital allocation going forward, since they've consistently made solid acquisitions, not solid, but a good amount of money to acquisitions. And then they just had $179 million sell-off so that they could fund their debt that was coming due. So, I'm basically just shooting blank. I don't know what to expect. But even with these not confident assumptions, it needs to fall 65%. So I don't want this company to be incredibly obvious for me to buy. And right now, it's not even looking like a little bit obvious. So I would just be reviewing other companies in the meantime and hope you enjoy the video. Have a great rest of your day. Thank you.